So this is a very important video. I request you to please watch this video at least 3 times and take notes. This will help you a lot because in this video I am going to discuss with you market conditions, how to look at the stock market and determine whether the market is in an uptrend or a downtrend, or it is trying to attempt a rally, or if the uptrend is under pressure, what is a market top, how to identify market bottom, things like that. Why is this important? Because the mm, overall stock market strength determines how your portfolio will do. So, for example, in William O'Neill's book, How to Make Money in Stocks, he says that if a major general market index is down on that particular day, 3 out of 4 stocks in your portfolio will be down. So let's take the example of the US market. So if the S&P 500 index is down on a particular day, then 3 out of 4 stocks are likely to be down on that particular day. Similarly, in India, if Nifty is trading in the red on a particular day, 3 out of 4 stocks will be trading in the red on that particular day. So the general market index, which represents majority of the trading volume or majority of the turnover in the market, okay, a major general index which represents the economy, which represents the stock market, if that index is down, that is going to have a huge impact on your portfolio. So it is very important to pick one particular general market index or 2 or 3 general market indices and watch them, study them on a daily basis to determine the health of the stock market. So in India, uh, the most popular index in India is the Nifty 50. So it's an index of top 50 companies in India by market capitalization, and majority of the trading volume or turnover or market capitalization is in these top 50 companies. Okay, so it's like a representation of India. It's like a representation of the economy. It's a representation of the entire stock market. So I will take the example of India in this video, but you can apply the same concept in any other market in the world. Okay. So, as per MarketSmith India platform, there are 4 states of the market. So, let me explain. So, you go to MarketSmith. This is the homepage of MarketSmith. Let me sign in. And by the way, to use this, you don't need to have a pro subscription to MarketSmith to understand market conditions. You don't need a pro subscription. I will just show you the link. You can use that link directly to determine what are the market conditions according to MarketSmith. Okay. So here it says at the home page itself, it says rally attempt. So this is one of the states of the market. So you click here, view more, and then you click here, view history. Now this link is very important. I will, I want you to pause the video. Okay. Take note of that link, marketsmithindia.com/ms tool/market condition history.jsp. If you put that link in any browser, even if you don't have subscription to MarketSmith, this will work for you. Okay. So we are very fortunate that MarketSmith has given us this information for free, and it is extremely powerful information. Okay. And not only do they give you what the market is doing right now, they also tell you what to do in these kinds of conditions. Okay. So if you go to this page, pause the video, write down this link, or somebody who is watching this video, please take the link, put it in the comment section so that other people can just click on that link and get access to this page. Okay, it's a very important page. You don't need pro subscription to get access to this page. So as you can see, this is market condition history. Okay, so there are 4 states of the market: confirmed uptrend, uptrend under pressure, rally attempt, and downtrend. And I will use the chart of Nifty in India to explain what they are trying to tell here. Okay. As you can see here, They mention the dates. So this is the start date, this is the end date, and they will tell you during these two dates what state the market was in, what was the market environment. So from 14th November to 25 November, they say the market was in downtrend. So from 26th November to current date, so it's been 2 days, the market is in a rally attempt stage. So from here, from 4th of October to 25th October, it was uptrend under pressure. From 11th of June till October, the market was in a confirmed uptrend. So that's how you read this table. Okay. Now, this itself is fine. If you can read this table, that itself is okay. But in this video, I want to explain to you what they mean by these terms, how they arrive at these terms. By the way, this is these terms that they mention. This is not an opinion of Market Smith. This is based on 125 years of stock market data analysis and study. They studied the stock market for 125 years and they came up with certain factors that we should look for when we are studying a particular index. And based on those mathematical factors, they have arrived at these four states. So this is all automated. There is no committee that sits and gives their opinion on the market. This is what it is. This was decided and planned years ago by William O'Neill, who founded Market Smith. So it's based on system, it is based on data, it is based on fact, it is based on analysis. Okay, this is not an opinion. This is based on observed fact. Okay, this is very important. So let's look at the first. Let me help you first understand what is rally attempt. Okay, so let me click here. If you click here, this window will open. See, it says a rally attempt begins the third day the index closes higher of the most recent bottom after being in a correction, also known as downtrend. Okay, so let me help you understand this statement. A rally attempt begins the third day the index closes higher of the most recent bottom. So you go to Nifty, okay? You see what is the most recent bottom? The low of this candle, right? After the low of this candle, we want three candles which consecutively close above the low of this candle. Okay, that's what they are trying to say here. Third day, the index closes higher of the most recent bottom. So the low of this candle is the most recent bottom. Now you have three candles which have closed above the low of this candle. So on this day, which is 26th November, the market goes into the rally attempt. Okay, rally attempt stage. So this is rally attempt stage. So that's why 26th November till current date, the market is in rally attempt stage. Where else what it was? 7 November to 13 November. So let's go to 7 November. Okay. So this is 7th of November. So let me hide this. Okay. So now tell me what's the latest low in the market. So the low of this candle is the latest low in the market. After that, you have three consecutive candles which have closed above the low of this candle, right? So that is why on 7th of November, the rally attempt begins. So basically, after the low is formed, you have to wait for three candles. Okay. All three candles must close above the low, above the recent low. Okay. So 7th of November, the rally attempt begins. Okay. Ends on 13 November. Why did it end? So let's go to 13 November. See, this is 13th November. So rally attempt starts here in 4 days. 1, 2, 3, 4. In 4 days, the rally attempt ends because this candle has closed below the low of this candle. Okay. That is why they say from 7 November to 13 November, the stock market staged a rally attempt and that rally attempt failed. When rally attempt fails, what happens? The market goes in a downtrend. That is why from 14 November, the market went in a downtrend. So after rally attempt failure, the market will go into a downtrend if that low is taken out. Okay. Now, if that low is not taken out, what happens? So in this, see, after rally attempt, it went into a downtrend. Here, after rally attempt, it went into a uptrend. Now, how does that happen? Let me explain to you. So now the low, recent low, 1, 2, 3. So on 26th of November, which is yesterday, the rally attempt has begun. Now, the fourth day, fifth day, sixth day, and seventh day, according to Market Smith, are extremely important now. During these 4 days, if there is a candle which closes 1.5% above the previous day close on higher volume than the previous session, that's called as a follow through day. Okay, let me repeat that. These are 3 days closing above the recent low. That's when the rally attempt starts. Okay, now after the third day, the fourth day, the fifth day, the sixth day, and the seventh day. Out of these 4 days, if you see one candle where this number is 1.5%, okay, positive. If you see one candle which closes 1.5% above the previous day close and which has higher volume than the previous session, that is called as a follow through day. If we get that follow through day, the status of the market will change from rally attempt to confirmed uptrend. Okay, and if that doesn't happen, okay, then the status does not change to confirmed uptrend. Okay, that is when the market will go up. But if the market starts to fall and undercuts this low, okay, that is when we say that the rally attempt has failed. So that this is what Market Smith has found out. After studying 125 years of stock market data, studying the tops and bottoms in the market, they have found out that after the recent low, you wait for 3 candles. That's when the rally attempt starts. And when you get that follow through day, that 1.5% day, that is when the uptrend is confirmed. If you don't get that day, the uptrend is not confirmed. Another way the uptrend is confirmed is when this high is taken out. That's the recent high. Okay. That is another way to determine whether the confirmed market is in a confirmed uptrend or not. So now I hope you understand what is a rally attempt. Okay. Now after rally attempt, the market went into a downtrend. So if I click here, see, the major index generally goes into correction when the number of distribution days in the last 5 weeks rises to 5 or 6. Now, what is a distribution day? Basically, a distribution day is a day when the index closes down by more than 0.2% on higher volume than the previous session. Okay. So, for example, if you look at this day, okay, the volume on this day is higher than the volume compared to the previous session, okay, and the closing is 2 point something percent, 2.12%. So the market has closed down by more than 0.2%. That is first condition. Second condition, the volume on that session is higher than the volume on the previous session. If both the conditions are satisfied, that's a distribution day. If you look at this candle, it has closed by 1.41% down. However, the second condition is not satisfied. The volume on that day is lower than the volume on the previous day. Okay, so that is why this is not a distribution day. This is a distribution day. Okay, have a look at this day. It has closed 0.9% below and the volume is above the previous session volume. So that's a distribution day. This is a distribution day. This is a distribution day. So the volume should be higher than the previous session's volume. So what Market Smith is saying is that if the number of distribution days in the last 5 weeks, so from here you go back 5 weeks, okay, if there are 5 or 6 distribution days between this day and 5 weeks ago, if you find 5 distribution days, okay, that's a confirmed downtrend. Okay, so you mark a line here. Let's say you mark a line here. You go back 5 weeks. 5 weeks means from 26 November you go to 26 October. Before 26 October, you go back another 7 days. Okay. So roughly 15th of October, 19th or 15th of October. Okay. So let's go to 15th October. Okay. So during these two yellow lines, if there are 5 distribution days, and a distribution day is something that is mathematically defined. Okay. If there are 5 or 6 distribution days, that is a confirmed downtrend. Okay. So this is very important to understand that the states that they mention here, these states, these are mathematically defined. Okay. So the major index generally goes into a correction when the number of distribution days in the last 5 weeks rises to 5 or 6. The index has typically declined 5 to 7% or more from the recent high. So as you can see here, from the recent high, the index has easily declined more than 5 to 7%. That is why they say it's in a downtrend. And also, the index most likely breaches its support levels of 50 and 200 day. So check. The blue line is the 200 day. The red line, blue line is the 50 day. Red line is the 200 day. See here, the index has breached both the levels. Here it already went below the 50 day. Here it also went below the 200 day. So they are defining mathematically what is a confirmed downtrend. Okay. Investors now they also tell you what to do in such situation. Okay. Investors should avoid new purchases. So whenever you see red color here, don't buy during that period. Don't buy anything. Okay. Number one. Number two, get off margin. So there are some people who borrow money to invest in the stock market. So if you have done that, please clear off that borrowed money, get off margin. And number three is raise cash. What do I mean? What do they mean by raise cash? Raise cash means you either sell all of your portfolio, or you sell 50% of your portfolio, raise cash, or you sell 75% of your portfolio, raise cash. This is what I have understood after reading a lot of MarketSmith material. Basically, what they are trying to say is that the probability is very high that the market will go down. So you should raise cash by selling uh, some, at least some portion of your portfolio, 50 to 75% or maybe 100% of the portfolio. Depends on where your stocks are compared to your buy point. You may not want to sell all of the stocks in your portfolio. So basically raise cash. They don't specify what percent of your portfolio you should liquidate. They are just saying raise cash. I would say 50 to 75% of the portfolio. Now, this is a good time to build your watch list of fundamentally strong stocks that you would like to own when the market condition improves. So, we have to, during this time, we don't have to make new purchases. We just have to build a list of fundamentally strong stocks. And when this red color becomes orange color or green color or even rally attempt, then we can choose to buy those stocks provided they are coming out of a proper base. Okay. So the marketsmith clearly said during this time, during these 11 days, do not buy. They clearly mentioned that. That's the beauty of the MarketSmith platform. They tell you what to do. Not only do they define these conditions, you can click on this and read the definitions. Okay. Not only do they define how these conditions come, they also tell you what to do in those conditions based on their historical studies. Okay. So now I hope you understand rally attempt means 3 closes after the recent low. Okay. Then downtrend means the index is 5 to 7% below the latest high, 5 to 7% or more. Maybe it is below the 50-day and the 200-day, and the number of distribution days are roughly 5 to 6 distribution days with over a period of 4 to 5 weeks. Three conditions, very important, very simple, very mathematical, very objective. Okay. This is how we need to identify a this is how you identify a market top. This is how you identify a market bottom. So if you understand these two, it will help you a lot. Basically, we have to become extremely conservative or extremely tight in our risk management. So basically, if if you find a setup where there are 4 points in the base, okay, and the yellow line is in the blue zone, that's a risky purchase. We can't buy the stock if the market is in these two states. Please understand that. Okay. So I'm connecting this information directly to the our base, what we look for in the base colors and the points and the 10 candles. So if you have been watching my videos, you will understand what I'm saying. If you have not been watching my videos, please spend time on my YouTube channel and then again come back to this video. You will understand this video better. Okay, that is why I told you earlier, please watch this video 3 times. It is extremely important. Okay. Now, what is a confirmed uptrend? Now, these two are states where you can actually buy. They allow you to buy, and I mean, they recommend that you make your purchases when the market is in these two states. Very important now. When the market is in confirmed uptrend, they say that you have to buy fundamentally strong stocks. The emphasis is on fundamentals, not the technicals, which means even if the stock is not technically very strong, but fundamentally strong, you could still buy the stock because the market is in a confirmed uptrend. So, for example, if you find a stock, let's say Zomato, okay, this will be very easy for you to understand. So, have a look at this. Have a look at this base. Okay. How many points in the base? 1, 2, 3, 4. Okay. 4 points in the base. Where is the yellow line? The yellow line is in the blue zone. Normally, when the yellow line is in the blue zone, I am demanding 6 points in the base. Okay. 6 points in the base means 3 contractions. If I don't get 6 points, I am not buying the stock. Why? Because currently the market is under pressure. Okay. However, if I see the same chart when the market condition is green, I might buy the stock because now the market is in a confirmed uptrend. So even if it is technically weak but fundamentally strong, I can buy the stock. But if this state is orange color, then what I will do is I will buy stocks which are fundamentally and technically strong. So the weaker the market, the stricter should be your criteria. The weaker the market conditions, the more strict your filter should be. The weaker the market, the more points you should demand from the chart. That is what I'm trying to convey to you. If you understand what I said, it will help you avoid a lot of losses. Profits are not guaranteed, but I can tell you, you can avoid a lot of losses, a lot of pain in the future. Okay. So remember, confirmed uptrend means we have to buy fundamentally strong stocks, even if they are technically not in an optimum situation, which we want. Okay. Now imagine a stock where you have 6 points in the base and the yellow line is in the green zone and the market is in a confirmed uptrend. That's like, I mean, icing on the cake. That's like heaven. Okay. I mean, everything is in your favor. The probability of success is very high. Okay. But imagine there are 4 points in the base, yellow line in the blue zone. Okay. And the market uptrend is in uptrend under pressure. Okay. That is not the time to buy that stock. Okay, so market conditions are directly related to your trade execution decision. Market condition is directly related to your risk management decision. Market condition is directly related to your position sizing decision. All of this is interrelated. So the chart of Nifty, at least for Indian investor or trader, is extremely important. We have to look at that chart on a daily basis. We have to look at this page on a daily basis. Okay. So what's a confirmed uptrend? So a confirmed uptrend status indicates the Nifty is in an uptrend. Okay. Uptrend begins with a follow through day or when the index reclaims its previous uptrend high. So as I mentioned, if you go to the Nifty, for a confirmed uptrend, for the market to go into a confirmed uptrend, there should be a follow through day. Remember that 1.5% day. Okay. 4, 5, 6, 7. During those 4 candles, if there is one candle which closes up 1.5% from the previous day close on high volume than the previous session, that's a follow through day. at least that condition should be satisfied, or this high needs to be taken out. If one of those condition is satisfied, immediately they will say that the market has gone into a confirmed uptrend. Okay, that's what they mean by this statement. At this stage, the index is not showing signs of significant distribution. I already explained to you what is a distribution day. So during this stage, the index does not show that 0.2% fall in a single day and a volume higher compared to the previous session, or heavy selling by institutional investors. So during confirmed uptrend, institutions are buying, they are not selling. This is the perfect time to be looking out for fundamentally strong stocks at proper buy point. Notice they don't say technically strong, they say fundamentally strong. Okay. Yes, proper buy point means you have to identify the base properly on the daily or maybe the weekly chart. You identify the proper buy point, you buy the buy point. Even if it is in the blue zone, you could buy the stock provided it is fundamentally strong. Okay. So when the market is in a confirmed uptrend, we can relax some of our criteria. Okay, we cannot be too strict with our criteria. If it's giving us a proper buy point, if it is giving us a proper base, if the stock is fundamentally strong, we can go ahead with the purchase. That is what they are trying to say. This is a time in the market when the lot of buying is coming into the market, so we should not miss out on the opportunities. Next, what is a confirmed uptrend? Click here. What is uptrend under pressure? An uptrend under pressure market status is normally associated with rising number of distribution days on the Nifty. So when the distribution days, that 0.2% day, when they start to pile up, that is when the uptrend begins to come under pressure. Index has 3 to 4 distribution days in last 5 weeks. So over a period of 5 weeks, if you get 3 distribution days, that's when that green will become orange. Okay, that status will change. It is showing some signs of deterioration. Index may be close to its 50-day or 200-day. See, this is exactly what happened. Let's say the market was uptrend under pressure 4th to 25th October. Let's go to 4th October. Where is 4th October? This is 4th October. Where is 25th October? This is 25th October. See, the market is close to the 50-day. That's what they say here. The index may be close to its 50-day or 200-day moving average support level. So is it close? Yes, it is close during that period, right? It is close to one of these levels. Then what they say is typically above at least one of the levels, means blue line and red line, it's the market is typically above at least one of the levels. In this case, it's below blue but above red. So you see how precise their understanding of the market is without even looking at the chart. Okay, they have already mentioned the state, and when I compare their state with what I see on the chart, it matches exactly. That's the power of analysis, that's the power of data, that is the power of research. So this information is extremely important. Investors need to exercise caution, which means you can buy, but you have to be cautiously optimistic, which means you have to micromanage your trades and keep their buying decisions reserved to fundamentally strong stocks showing technical strength. Now, this statement they did not make when the market was in a confirmed uptrend. Why are they making that statement here? Because the uptrend is under pressure. Okay. So I hope now you understand. Let me summarize everything for you. When the market is in a confirmed uptrend, basically when it is green, look for fundamentally strong stocks at proper buy points. You are allowed to buy. Okay. There is a follow through day in the market, or maybe the previous index high has been taken out. This is a good time to buy. Then uptrend under pressure. Here you look for fundamental and technical strength, and you become more strict with your criteria, more strict with your risk management, more strict with your trade execution and trade management and position sizing. Okay. So in these two states, you are allowed to buy. In a downtrend, you are not allowed to buy because the number of distribution days has increased. The index is 5 to 7% or more below the index high. Okay. Rally attempt. three consecutive closings above the recent low, and then we wait for a follow through day. So basically, I hope now you understand what I mean by all of these four. You can click here, you can read all these statements. Even there are hyperlinks here. You can click here. It will tell you the definition of a follow through day. Okay. By the way, all of this I have already discussed in this video. So for revision, you can just for academic reasons, you can go and read all this. Okay, I've already explained that to you. That is how I learned it. Okay, so we are very fortunate. Lots of gratitude to MarketSmith for giving us this information. I am not officially associated with MarketSmith in any way. I don't have anything to do with them. I just appreciate the work and the research that they have done. And this information tells me when I should be cautious in the market, when should I be micromanaging my positions, when should I be aggressive in my portfolio. So I hope this video has been helpful. Some one of you, please, I request you, one of you who is watching this video, please take this link, put it in the comment section so that other people who are watching the video also can get access to that link. I normally don't update my video description, it's all automated, so I don't want to do that. That's why I'm requesting you to do that. Okay. So I hope this video has added value to your trading journey. Do not forget to download the swing trading checklist, the position trading checklist, the stock categorization checklist. It will help you a lot. It will help you ask questions to yourself that you should be asking before putting a stock on your watch list. And when you combine those questions with this information, it will significantly improve your stock selection process. Okay. Plus, also don't forget to check out my premium educational resources. I have training, coaching, video courses, things like that. Also, I have a podcast, so check out that as well. Please send me your likes, comments, and shares and questions. Okay. I answer each and every question. If you send it on email or WhatsApp, I can reply with voice message. Okay. Thank you so much for your time. Thank you so much for your support. Have a fantastic day today. Okay.